No, this isn't financial advice from an accountant. These are the words of a billionaire.
Honestly, I have brilliantly used those laws. I have often said that I have a fiduciary responsibility to pay no more tax than is legally required, like anybody else. Or, put another way, to pay as little tax as legally possible.
That's right. Those words come from Donald J. Trump, a prominent figure in American capitalism. Whether you're a business tycoon or just working hard to make ends meet, one thing's for sure. Nobody wants to pay more tax than they absolutely have to. So, in 2 videos, I'm going to show you 8 powerful strategies to keep more of your hard-earned money from going to taxes and keep more of your money where it belongs, in your own pocket. Let me quickly explain how the UK tax system actually works. It's what we call a progressive system. Basically, this means the more you earn, the higher percentage you pay on parts of your income. Think of your income like a layered cake. The bottom layer, the base of the cake, is your personal allowance. For most people, that's £12,570. This bit is completely tax-free. You don't pay a penny on it. Then, you've got the next layer, where you pay 20% tax on income between £12,571 and £50,270. We call this the basic rate. Go above that, between £50,271 and £125,140, and you're paying 40%. That's the higher rate. And finally, if you're earning over £125,140, you'll be paying 45%, the additional rate. Just a quick heads up, these rates are a little different in Scotland. So, when it comes to paying less tax, it boils down to 3 key areas. First, claiming all the expenses you're entitled to. Second, using tax-efficient savings and investment vehicles like ISAs, individual saving accounts, and pensions. And third, making sure you're claiming all the available tax reliefs, which can reduce the amount of your income that's subject to tax. Right, with all that said, let's get into those 8 ways to legally cut down your tax bill. Number 1, ISAs, or individual savings accounts. These are a fantastic way to grow your wealth while keeping your tax bill down. For the 2024/25 tax year, you can put up to £20,000 into ISAs. The really great thing is that any interest you earn, any dividends you receive, and any profit you make when you sell investments held within an ISA are all completely tax-free. There are a few different types of individual savings accounts, so let's take a quick look. Cash, ISAs. These are the simplest type. Think of them like a regular savings account, but with a big tax advantage. Any interest you earn is tax-free. You can also access your money whenever you need it without any penalties. It's always worth shopping around for the best interest rates, and you can easily transfer your cash, ISAs, to another provider if you find a better deal. This way, you can make sure your savings are working as hard as possible. Stocks and shares ISAs. These let you invest in things like stocks, bonds, and funds. Any profit you make when you sell these investments, known as capital gains, is completely tax-free. Plus, any dividends you receive from shares held in the ISAs are also tax-free. This makes them a really good option if you're looking to grow your investments over the long term. Lifetime ISAs, LACEs. These are designed to help you save for either your first home or retirement. The government gives you a 25% bonus on your contributions, which means for every £4 you put in, they add £1 up to a maximum bonus of £1,000 each year. It's like free money. Innovative Finance ISAs. These are a bit more specialised and let you invest in things like peer-to-peer loans. So, in a nutshell, ISAs are a really flexible and tax-efficient way to save and invest. Whether you're saving for a rainy day, a house, or your retirement, there's likely an ISA that can help you reach your goals faster. Next, let's talk about pension contributions. Putting money into a pension is a really smart way to lower your tax bill and save for retirement. When you contribute to a pension, you get tax relief straight away. You can contribute to a workplace pension through your job, or a SIPP, that's a self-invested personal pension, which you set up yourself. With a SIPP, you can pay in up to 100% of your earnings, up to a maximum of £60,000 each tax year, and get tax relief on your contributions. Here's how it works. Let's say you want £100 to end up in your pension pot. If you're a basic rate taxpayer, you put in £80 and the government adds £20. This means you've saved £20 in tax that you would have paid on that £80 as income. If you're a higher rate taxpayer, you effectively only need to contribute £60 to end up with £100 in your pension. Here's why. You put in £60, the government adds £15, bringing the total to £75. Then, through your self-assessment, you claim back an additional £25. This means you've saved a total of £40 in tax on what would have been £100 of income, which is equivalent to 40% tax relief. If you're an additional rate taxpayer, you effectively only need to contribute £55.56 to end up with £100 in your pension. For simplicity, let's round this to £55. You put in £55, the government adds £14, bringing the total to £69. Then, through your self-assessment, you claim back an additional £31. This means you've saved a total of approximately £45 in tax on what would have been £100 of income, which is equivalent to around 45% tax relief. Inside your pension, your investments grow completely tax-free. You don't pay any capital gains tax on profits or income tax on dividends. Okay, so when can you actually get your hands on your pension? Well, usually from age 55, although that's going up to 57 in a few years, 2028. When you do start taking money out, the first 25% is tax-free, which is great. The other 75% is taxed, like regular income. Now, you can't completely dodge tax on that part, but there are some smart strategies to make your withdrawals more tax-friendly. We'll explore those in another video, so stay tuned. Okay, let's talk about workplace pensions. These are a must-have if you're employed. Why? Because they're like a superpowered savings account for your retirement. Not only do you put money in, but your employer has to contribute too, usually at least 3% of what you earn. And the best part, you often get tax relief on what you put in. So, you're basically getting free money from the government and your boss. Plus, your money grows tax-free while it's in there. Pretty sweet deal, right? Now, if you own your own company, this gets even more interesting. You can pay yourself directly into your pension, which can be a really tax-efficient way to take money out of your business. You can contribute up to your full annual allowance, £60,000 for 2024/2025. If you have no earnings, you can still pay in £3,600 and receive tax relief. This can significantly reduce your company's corporation tax bill. So, whether you're an employee or a business owner, pensions are definitely something to consider. If you're thinking about opening a SIPP, some popular platforms include AJ Bell, Interactive Investor, Money Box, and Pension B. And for workplace pensions, common providers include Nest, the People's Pension, and Now Pensions. There are many others available, so it's always worth doing some research. Moving on to another key area for tax efficiency: incorporating or setting up your business as a limited company. Running your own business this way can often mean paying less tax than if you were simply employed. One of the biggest advantages is that businesses can claim tax relief on many everyday business expenses that someone working for a company can't. Think of things like office supplies, business travel, and staff salaries. You can deduct these costs from your profits before tax is calculated. So, let's say your business makes £100,000. If you've spent £30,000 on allowable business expenses, you only pay tax on the remaining £70,000. That clearly means a lower tax bill. Another key difference is how the profits are taxed. Companies pay something called corporation tax, and the rates for corporation tax are often different from the income tax you pay on your wages. Sometimes, the corporation tax rate is lower than the higher rates of income tax. For example, while someone earning a high salary might pay 40% or even 45% income tax, a company might pay 19% or 25% corporation tax. This can make a significant difference to how much money you keep, especially as your business grows. Plus, running a business as a limited company gives you more flexibility in how you manage your income. You can choose to reinvest profits back into the business, which can also be tax efficient. For example, you might invest in new equipment or undertake further training. You also have some control over when you take money out of the business as dividends, which can allow you to utilize your tax allowances more effectively. For example, if you've used up your personal allowance and dividend allowance in the current tax year, you might choose to take dividends in the following tax year to use your new allowances. This is about managing your income flow within the tax year, not avoiding tax altogether. By being smart about how you manage your finances within the company, you can often end up paying less tax overall and have more money to reinvest and grow your business. It's important to note that setting up a limited company also comes with additional responsibilities and administrative tasks, so it's important to weigh up the pros and cons and potentially seek professional advice. Another strategy to consider, especially for small business owners, using the cash basis of accounting, is timing your expenses. This is a really clever way to manage your tax, especially if you run a small business and use what's called cash basis accounting. Basically, this means you record your income and expenses when you actually receive or pay the money, not just when you get an invoice. Understanding this can help you make some smart decisions about when to spend money. Here's the idea. If you think your business will make more money this tax year, it might be a good idea to bring some expenses forward. This means paying bills or making purchases before the end of the tax year. This lowers your profit for this year and therefore lowers your tax bill. On the other hand, if you expect your business to make more money next year, you might want to delay some expenses until the new tax year starts. This pushes those deductions into the next year, which could be more beneficial if you're in a higher tax bracket then. Let's illustrate with an example. Imagine it's March. The end of the tax year is approaching, and you know you've had a profitable year. You also know you need a new laptop for your business. If you buy that laptop in March, you can deduct the cost from this year's profits, reducing your tax bill for this year. But if you wait until April, the start of the new tax year, to buy it, you deduct the cost from next year's profits. So, by carefully planning when you pay for things, you can make sure you're getting the most out of your tax deductions. So, Don't try to navigate the complexities of tax on your own. Investing in professional advice can often save you much more money in the long run. If you've successfully used any of the methods we've talked about, or if you have other tax-saving tips to share, please let us know in the comments below. We'd love to hear from you. Thanks for watching, and we'll see you in the next video.